All right, today we're jumping into the world of self-storage to unpack CubeSmart's latest earnings. Now, they're signaling what could be a pretty big turnaround after a tough stretch. But the real question is it for real? Let's break it down.
So right out of the gate, CubeSmart's CEO, Christopher Marr, makes this really bold claim. He calls it an inflection point. Now, in the finance world, that's a huge statement. It's basically saying, hey, we're not just staying afloat anymore. We're actually turning the ship around and heading in a much better direction.
Okay, so that's a great soundbite from the CEO, but does the data actually back it up? Is this optimism built on solid numbers, or is it just wishful thinking? That's what we're here to figure out. We're going to dig into the evidence piece by piece, starting with their Q4 performance.
All right, so let's get into the numbers. And honestly, when you look at Q4, the picture isn't super clear-cut. It's a bit of a mixed bag. You've got some definite wins, but also a few things that miss the mark.
So here's the quick and dirty summary. On the win side of the column, their revenue was better than expected, which is always good to see. And a really important metric, their move-in rates actually turned positive. But on the other side, a key earnings number fell short, and their net operating income, which is basically the profit they make from their properties, it actually went down.
Okay, let's start with the good stuff. Their revenue came in just shy of $283 million. That beat what analysts were expecting by more than $2.5 million. That's a solid top-line beat and tells you that, hey, demand for their storage spaces is still pretty healthy.
But here's the other side of that coin. We have to talk about something called FFO, or funds from operations. For a real estate company like CubeSmart, this is a super important number for profitability. And they came in at 64 cents per share, which was 2 cents shy of what everyone was hoping for. So yeah, that little miss definitely dampened some of the excitement from that strong revenue number.
Okay, this right here, this slide tells a really powerful story. This is probably the single biggest piece of evidence for that whole inflection point idea. I mean, just look at it. A year ago, their move-in rates were down a massive 10%. But then, quarter after quarter, you see this steady climb. Q1, Q2, until boom, Q3 and Q4 are both in positive territory. This is what stabilization looks like. This is a big deal.
All right, so moving beyond just their internal numbers, CubeSmart is kind of dealing with two big external forces right now. It's a bit of a good news, bad news situation. The good news is about their competition. The bad news, well, that's about rising costs.
So for what feels like forever, the entire self-storage industry has just been flooded with new construction, new competitors popping up everywhere. But check this out. That pressure is finally easing up for CubeSmart. Back at its peak in 2019, literally half of their stores had new competition nearby. Now, they're forecasting that number to drop all the way to just 19% in 2026. That is the lowest it's been in almost a decade. That is a huge relief for them.
But of course, there's a catch. Just as that competitive pressure is easing, the cost of just running the business is on the rise. And that is the main headwind they're flying into right now, something that could really squeeze their profits.
And when you look at the specifics, management is flagging a few key things they're worried about. They're getting ready for higher real estate taxes and bigger insurance bills, which, let's be honest, is hitting just about every property owner out there. They also specifically mention costs from winter storms, which makes sense since they have a lot of locations in the Northeast. I mean, we're already seeing this happen. Their same-store expenses were up almost 3% just in this last quarter.
So you've got this push and pull, right? Less competition, but higher costs. So what's the plan? What's the strategy? Let's take a look at how CubeSmart is planning to tackle 2026 and what their official guidance is.
Okay, here's their official playbook for the year. They're guiding for that FFO per share to be somewhere between $252 and $260. But you can really see that tension we were just talking about playing out right here in the numbers. Look at same-store revenue. It's pretty flat, maybe up a little. Now look at expenses. They're expected to grow quite a bit more. And what that means is their net operating income, that core profit metric, could land anywhere from a little bit down to just barely in the green.
So, given that environment, how do you actually create value for your shareholders? Well, management laid out a very clear plan for how they're going to spend their money. It's not just about running the stores day to day, it's about making smart financial moves. And that plan really comes down to a three-pronged attack. First, they're still on the lookout for good properties to buy. Second, they're teaming up with others, launching a massive $250 million joint venture to go after new growth areas. And third, and this is a big one, they're betting on themselves. They beefed up their share buyback program to almost $500 million. That's a pretty strong signal to the market that they think their stock is a bargain right now.
And all of this brings us right back to where we started.
On one hand, you've got some real evidence for that inflection point. Move-in rates are looking better and the supply pressure is letting up. But on the other hand, you've got those pesky rising costs and a pretty cautious forecast for the year. So the big question is, will this three-pronged strategy be enough to actually get growth fired up again? That's the billion-dollar question for anyone watching CubeSmart heading into 2026.